Great. So just by way of background, again, I'm Ben Tata, president of Standard Media Index. SMI has been around for about 10 years, and it's become the single trusted source for global ad spend and pricing intelligence. We currently aggregate billings data from actual invoices from all the large holding companies. We recently added Group M and IPG to the mix, which now completes all of the holding companies and large independents. Basically take information and kind of transform it into kind of a structured data set that the agencies can use for benchmarking and that we can bring to the market in the form of kind of census-based spend and pricing data. So if we kind of look at the streaming video space, it is very complex, and it's great that Guy started with, a little bit of the acronyms. We tend to look at AVOD as a type of video. Within that, there are a number of different subtypes. So for starters, kind of separating, ad-free subscription services from ad-supported services. We'll focus obviously on ad-supported services. There are basically three types of video services that are grouped. So TV Everywhere are services that are literally a replica of kind of their linear equivalent, in the case of MVPDs that have launched IP service apps basically that replicate the cable bundle. TV networks, which basically are replicating kind of a channel-specific service on OTT. And then there are pure play services that were kind of born and bred on digital that launched on the space as pure plays. And within that, we've got AVOD, which is the large and growing number of services and digital pure plays, whether those be Hulu or Vivo, or whether they're kind of network-based portals like Discovery Plus and Peacock that kind of aggregate not only TV content, but also film content as well. And then vMVPDs are basically virtual MVPDs that also have launched pretty robust ad businesses. I think the vMVPDs and MVPDs are very similar. I think the difference with MVPDs is a local concentration, whereas the vMVPDs are generally national. And then finally, in exchanges, basically all the programmatic placements that are made. And in terms of connected TV, because this gets, there's a lot of confusion between OTT and CTV. We look at connected TV as a device type or a platform. So a good example would be Roku. Obviously, they have platform-based ads, navigational ads, and so forth that are specific to the platform. But then as you'll notice, they're also an AVOD because they have the Roku channel, which is really a conventional OTT streaming service. So we look at CTV as a device type that captures revenue and advertising uniquely than the OTT equivalent. And obviously, a lot of OTT is delivered through those devices, whether it's Roku or Samsung. So let's get to the trends. What I did here was basically just give you an example of how these different services played out over the course of 2020. So obviously, there was a tremendous amount of OTT, but when you look at the subtypes, that growth varied. And obviously, when you plot that against linear, it's really interesting to see kind of where and when OTT grew versus linear. Obviously, Q2 was, everything came to a grounding halt. From March to May, there was a decline across the board. But what was really interesting, while it took several months for linear, which is that bottom plot line, back, OTT sprung back immediately. And what was most pronounced was the amount of money that went into ad network and exchange. Isn't surprising because you can basically activate at scale in a very quick time frame. So obviously that bounced back significantly right after that Q2 decline. And then the other services, whether they be pure play services or TV Everywhere, took a couple of months to grow back. But the long story short here, overall, even though it looks like things tailed off in December, overall, the OTT services were up 20 to 40%, depending on which subtype you're looking at. Linear nudged up slightly, but it was a growing year across all sectors. And it's just that the growth varied by subtype. So if we look at some data more recently, this is data from Jan to May versus last year, the trend continues. If you look at all of media, I mean, obviously, the year-over-year comparisons, you have to take into consideration the fact that there was that dip between March and May, but overall media grew 22%. Digital obviously was much more vibrant. And then if you look at OTT, it was up 55%. And then again, if we delve into those subtypes, it really tells an interesting story where OTT pure play services outgrew the category, by 15% or so. TV everywhere, because again, there's a strong local concentration. Local ad businesses were impacted severely. So obviously the growth rate is slightly less there. And then programmatic and ad network and exchanges. So the placements that are made for OTT through those platforms continues to grow at a significant rate. And obviously a trend that'll continue. So if we kind of switch to pricing, we just recently launched kind of a cross-screen pricing intelligence suite where basically we translate linear rates, linear ad costs into effective CPMs so that you can compare on a like-for-like basis what the rates are for television as compared to digital video and OTT. So this is just kind of a real top-line view. And I want to caveat it by saying this is persons 2+, so it's all audiences across both linear and digital. And you can see here that, not surprisingly, the TV rates are slightly higher than digital video. Not materially, though. But then when you look at OTT, it tells a different story. OTT premiums are significant. It's about a 30% premium over linear. And that's pretty consistent. And I think that has a lot to do with the fact that you've got brand safe content, commercial grade programming, and authenticated services and authenticated impressions with OTT and the targetability, with the reach of television. So it is the best of both worlds. It's not surprising. I think the other message out of this is just how efficient television is, because it's never really been expressed, bought, and sold on a CPM basis. I think it's tough to understand just how efficient it is. But without a doubt, it's tremendously efficient. So when you look at what's driving rates, this is also an interesting comparing linear to OTT. In this case, we've got the networks basically plotted on a matrix where you have CPM low to high on the x-axis, the number of impressions per campaign on the y-axis. And what we see is there are really two groups of networks. You've got the large mass reach broadcasters on the right, and then you have the thematic cable channels on the left. So the message here is that reach drives rates. Even when factored on a CPM basis, those networks are really driving premiums because of that reach. And it also has a lot to do with the advertiser appetite. They gravitate to TV because it's by far the most dominant reach vehicle. On the digital video and OTT side, and this plots the same matrix, but in here we've also included all the different types of online video as well as OTT, kind of see how they stack up. And what you find here is that OTT and kind of niche targeted video is what drives rates when you're talking about digital video. So apps like CBS Sports, NBC Sportsnet, ESPN, obviously they're driving premiums. Then you have the market makers in OTT and connected TV, Hulu and Roku, which are pretty dominant. And the size, I should have mentioned, the size of the bubble reflects the size of the revenue. Obviously, there's a tremendous amount of revenue that they garner. And then on the left side of this, of the matrix, you've got the social sites and kind of the more conventional pure play video sites, YouTube, et cetera, that are on the lower end of the spectrum. Not surprising. They kind of trade off of conventional video CPMs. What's interesting here is that you've got the Trade Desk, the programmatic platform, sitting in the middle, which was surprising. You typically think of programmatic as being kind of, the most efficient or least costly option. But you can judge by this that they're moving a lot of premium grade video and OTT these days, which kind of props up those rates. So for the first time, a programmatic platform is kind of, trading on pretty healthy premiums when it comes to video. So if you kind of switch gears into the genre-based view of OTT, what we've done is we've isolated those those apps and services that skewed on the upper end of the CPMs, and they're specifically sports apps. So if we isolate just what we've done is we've dipped into our spend information to see what the concentration is by advertiser category. So for any of these sites, what does automotive and prescription drugs represent as a percentage of all the categories that they see? And you can see here that auto and prescription drugs for these OTT services represents upwards of half of all the revenue garnered by those channels. Pretty interesting, but it was extremely interesting when you compared that to sports programming on linear. So when you look at it that way, television, the automotive sector for this period, which was October to April 2021, represented 13%, so far less there. And then when you get to prescription drugs, drops to 3.1%. So what this is telling you is that, certain ad categories are gravitating to OTT at different levels. Obviously, auto and prescription have really shifted their investments pretty significantly and are kind of overspending compared to what they're spending on a percentage basis with linear. If we take a step back and look at it across all categories, if you look at it kind of a linear versus OTT and streaming mix, all categories spend about 22% of their OTT mix on OTT versus 78% linear. But you can see certain categories way over indexed. Accessories, literally 3x the average. Travel, services, entertainment, and media, which is not surprising since there's a lot of tune-in going on with the new OTT services, and technology and CPG. So the message here is just that in order to really get an understanding of what's happening from a business perspective, it's really important to look at the media subtypes and things like the ad categories to get a sense as to how the market is moving. I think, in summary, it bodes really well. I mean, obviously, audiences are shifting. Guy did a great presentation on the consumption changes and the investments in programming. That's going to continue, and the dollars are following, obviously. Major categories are strengthening their OTT mix. I think this is going to be a lot of the head scratching going forward is what is that right mix, because the two complement each other well. I think also, one of the points here is just that TV-based services are commanding unprecedented premiums. I think it's, even though it makes sense because of the targetability, the brand safe nature of television-based content, but it really is impressive, the premiums that are garnered, and conversely, how efficient linear is. And then one of the most important points for us is that we're working with common metrics. This is so important for the industry. By converting linear TV from a unit rate GRP to an eCPM, we can finally look at it on the same basis of digital and make those trade-offs, those comparisons, and optimize cross-screen on an apples-to-apples basis, which is truly essential going forward. So I know there's not enough time for questions, but I'll be here for the rest of the day, and I'm happy to answer any as they come up during the course of the day. Thank you.
Brilliant. Thank you ever so much, Ben. There was one that came in that said, is linear underpriced? But as you're right, we don't have time, but we will invite you back to get that answer, and we'll put that out to our VideoNet audience as well. But Ben, thank you ever so much for that. That was fantastic.